You've always drawn a parallel between managing your wealth and managing your health. And when was it that you realized that it's not just about chasing big returns when you're managing your wealth, but it's about habits like longevity, discipline? All of this is equally important.
If you really see, out of the two word, six characters, each of them have five have the same character. So maybe just coincidental, but there is a lot of. At least I could only relate, and it's easier for me to explain to the client that how and what you will do in one situation, and that actually can be very easily adapted in other situations.
I think that in India, especially, this direct versus regular debate has been going on for quite a while. So, as an advisor, how would you want to explain the real differentiation between the two?
It's like, direct is you have gone in the market and bought your equipment for gym. The second is, second person is basically going and taking really an instructor. Apart from buying the equipment, he's also deployed a real instructor who will guide him throughout the journey, right? Now, that's the difference one should look at it.
What are some of the classic mistakes that investors make? Maybe top three, and what should they do instead?
The classic mistake which an investor does it, he try to chase what has already done well.
The
Journey
recency
is,
bias.
you will be surprised that some of the seasoned investor investing for 20 years still have that temptation.
Hello, and welcome to the show. My guest today believes that managing wealth is no different from managing health. It needs consistent attention, disciplined choices, and a long term view. Joining me is Shailendra Sharma. He's a co founder of Claritas Wealth, a seasoned chartered accountant with over 28 years of experience across wealth management, advisory, and client leadership. He's in fact worked with some of the most respected names in the industry, including 361 Wealth Management, ING Vyasa Bank, Morgan Stanley, advising HNIs, family offices, and corporate clients. He co founded Claritas with a clear intent to challenge the conventional wealth model and build a structure. So, today we are going to talk with him about what real wealth advisory should look like, the direct versus regular debate, investor behavior, risk, SIP discipline, and why investing is not a product decision, it's a process. So, let's begin. Thank you so much, Shailendra, for joining us. Good to have you today.
Thank you so much for having me over here today. It's a pleasure to be here today.
So, it's interesting because you've always drawn a parallel between managing your wealth and managing your health. And when was it that you realized that it's not just about chasing big returns when you're managing your wealth, but it's about habits like longevity, discipline? All of this is equally important.
Yeah, so I guess it took some time to really understand, the parallels and how really both of them work. Through your experiences in early age, you are trying to always capture the best of everything and quickly, as much as possible. As you go along the journey, you realize that there is a huge parallel. At least I got that, uh, and the way I got it, relevance is I could only connect one with the another, and it's made me much more better prepared to answer my client, to accept what is happening, and then go along with that. If you really see, out of the two word, six characters, each of them have five have the same character. So maybe just coincidental, but there is a lot of. At least I could only relate, and it's easier for me to explain to the client that how and what you will do in one situation, and that actually can be very easily adapted in other situations. So that's really is the thing. If you really look at it, none of them can be achieved in shortcut.
Mm,
You can't achieve good health in 3 months, 6 months, 1 year. So nothing is shortcut over there. You need a very disciplined approach. It's not that if you have achieved certain level of fitness, it's done and dusted. You will easily can lose both of them. In spite of your best effort in either of the time, you could have a great health. You will see some kind of ups and downs. You will have a cold fever. Some kind of a things can always happen. So is in the wealth journey. You could have created wealth, but there are so much, really speaking, factors are working across the globe that you will see a situation where suddenly you see a dip, and suddenly see very unexpected dip and big. But you can't just stop managing, or can't stop believing in that discipline. You have to go back to the discipline, and that's the only way continuing your journey will keep you closer to your target, and I think will take you a level where then you are comfortable in terms of, so discipline, no shortcuts. In spite of your best effort, there'll be ups and downs.
And I guess
And
that you're in control, right? You can take care of your health and you can take care of your wealth as well. So you
absolutely, so
have
I
to,
guess that's very true.
ride that journey. And, you've spent 28 plus years across some very formidable institutions, ING Vyasa, for example, 361 Wealth Management. What is it being within these large companies that actually taught you about the difference between what's actually being sold in the industry versus what you need to sell and what a client truly needs, more importantly?
Sure. So see, I am absolutely thankful to the organization, these couple of organizations where I've worked, and I've worked reasonably long in each of them. Which whatever I've learned, actually I've learned out of those experience. I have started working into a wealth sector in 1996 after my CA, after I completed my chartered accountant, and it was more of accidental. I don't think the wealth management sector as a whole was as evolved and anything was there as significant as it is today. However, these organizations are the one which shaped me whatever I am today. So credit, there's nothing really in a dramatically way wrong in the bigger organization. However, what happens is, and specifically to do with the wealth management sector, is that as you grow bigger and bigger. So I worked in my in an organization which was a bank, other one which was a dedicated firm for the wealth management, right? For a bank, it was one service which was offered. For other one, it was only the service which they offered. The whole organization started with the same objective, where at least I stand today, that we have a set of client, we need to understand, we have to believe and see that what is the best suited to them, and work with each of the client very closely. What happens is, as you grow bigger and bigger, the connect with the clients starts getting little reduced on daily basis. Also, what happens is, you try and start putting client into the buckets, so it becomes easier. So what happens eventually, as organization grow bigger, you are basically in your mind have created four clients, and you're putting all the clients in either of the basket, right? And accordingly, you are trying to make the solutions created for them, and believe that it should work with most of them, ideally. And if not, at least it should with most of them.
Got
It gets even more complicated when the organization become even a manufacturer of the product, right? So once you are offering, you are selecting the best manufacturer, then eventually over a period you become a manufacturer. If it's very, I mean, it's bound to happen as a human, that if you are a manufacturer, you tend to get more, lean towards that product which you are manufacturing and offering, rather than somebody else manufacturing and offering. So these are the some of the things, which
Yeah.
we felt that as organization gets bigger, in a very specific, see, it's not a product, it's not a car. I can understand if it's a car, it will suit to most of them, you will add features and that's it, but it's a
Right.
very individualistic
Yeah.
business. And that is something, is the only thing I would say
Yeah.
gets little bit of compromise as the size of the organization gets bigger and bigger.
Absolutely. And wealth management is at your core. And being within this industry, I think that in India, especially, this direct versus regular debate has been going on for quite a while, because it's just assumed that when it's regular, it means expensive. And when it's direct, it means smart. So, as an advisor, how would you want to explain the real differentiation between the two?
Great question. I think it's a very great question, and I think it's the juncture where a lot of debate is happening on
Yeah.
this point, right? And again, I will try and connect it with my first point of health. It's like, direct is you have gone in the market and bought your equipment for gym, for your exercise. You have bought
Okay.
few equipment, and that is what you have done it. That is direct in terms of parallels, if I can relate. The second is, second person is basically going and taking a, really an instructor. So he's gone and joined a gym membership, or he has basically deployed, apart from buying the equipment, he's also deployed a real instructor who will guide him throughout the journey, right? Now that's the difference one should look at it. Now it's not that that you just bought instruments and you can't do it or yourself, but you have to really have a very, very disciplined question to ask yourself: can you manage? Do you have the wisdom? Do you have a corrective stage, knowledge and regularity, which an instructor will push you to do
Yeah.
it vis-a-vis independently you?
Absolutely.
So I think it's very important to have a very, I think, point blank questions, that if you can yourself become an instructor to you, then you can do it. But if you can't, which I believe and assume in most of the cases you can't, then you should not. So I think a cost is a very easy debate to have, and very easy answer to have, that obviously if you go direct you will save because the cost is lower. However, most of the time you lose bi- uh, much bigger than what you have saved in terms of cost, because if you don't have an instructor, you may do a wrong posture, you may have really taken a hit on your body, you may not be able to do consistently, there won't be any corrective measures. So there is a lot more emotional and behavior part in investing which is very widely underestimated, and that's where the advisor comes into the picture. So it's not, I think the debate about cost is to be looked upon or looked together in what you may lose, and if you don't lose those, if you can manage all of them, please go ahead with the direct
Yeah,
model. But think about it. That's what
absolutely.
my suggestion would be.
Absolutely. And it's very critical, especially in volatile times like these. But at the same time, we've seen SIP flows, hit a record of 31,002 crores in the month of December just recently. But at the same time, the SIP stoppage ratios are quite a lot as well. You spoke about this emotional aspect. What do you think? Why do you think we have this major mismatch?
Okay, I'll try. And so it's again, most of the questions, and most of the things in investing is much more to do with behavior
Absolutely.
aspect than
Psychology.
actually the mathematics part of it.
Mm.
See, what has happened is, thanks to the media, the various regulators, and fees and things like that, kind of keep coming and giving the information, advertisements which says that SIP is good, SIP is great to have. So it has become a recall value for any investor,
Sahi hai.
including the Hanyu. Sahi hai. It has hit
Yeah,
a chord which is
absolutely.
unparalleled, if I can think of that, in
Of
the recent
course.
past. So what has happened? SIP has become an easy mantra for most of the earning classes. However, still they have not have dived down little more, that SIP is just an entry. The whole journey of investment,
Mm.
specifically in a asset class like a equity, which has a huge volatility, is not taken away just because you're investing through SIP. You still have to remain invested. You can't escape volatility. You can't escape things going in a different sectors, in a different market cap. These all will remain. So it has become an easy starting point.
Hmm.
The problem is the journey has not been really been defined. They
Yeah.
try and say all of these disclaimers and everything, but I'm not sure really those young investors specifically is going. Then they keep chasing things and things like that. So that's a bit of a, and I'm reasonably sure as the journey has started, the learning will happen. And I think eventually we will not have these kind of a stoppage number or things like that, which we see today. I'm sure 5 years, 7 years down the line, there's 31,000 crore and stoppage number will keep getting reduced.
Reduced. Which brings me to my next point, because you spoke about this volatility and emotional aspect and behavioral, which is so critical. What are some of the classic mistakes that investors make? Maybe top three, and what should they do instead?
Okay, so classic mistake or situations which an investor really faces is always in a so-called volatile time. I don't want to use the word bad time because there's
Hmm.
nothing. It's a negative word, but a
Okay.
volatile time, right? Like last 15 months, point to point, there hasn't been any return or things like that, but there has been return in somewhere else, right? So things keep changing from a universe perspective. There are return in certain things and there are returns not happening in a particular period of time.
Right.
What happens is the classic mistake which a investor does, it he try to chase what has already done well.
Hmm.
So that's the one classic thing, and in that movement or that
The
journey
recency
is
bias.
correct. And that journey, and you will be surprised that some of the seasoned investor investing for 20 years still have that temptation.
Hmm.
And that temptation is what brings the advisor in picture, saying that, sir, this has happened. Now let's not go very heavy. Even if you
Hmm.
want to invest, it is now the time to go very moderate to low in that asset class. So that's one where the recent happens. Second, people really have the behavior, and that's connected. Actually, behavior is one of the most underestimated problem with human being as such, and when it comes to investment even more, because the behavior part of or being able to reason yourself on for the factor on the basis of which you invested, you normally don't go and reevaluate when the things are not good, saying that is any of them has changed. If not, just because I've not got the return in the past 15 months, I should not be. Maybe this is the time even go a little more higher. But that's other things again, the behavior that people do not go back to the reasoning which is what led them to invest, and figure it out if anything has changed over there.
Yeah.
So some of those things, chasing the tail, chasing the return of the asset class, behavior things, and temptation to make something, a very temptation to make some activity.
Yeah.
It's again a very, very behavioral issue.
Yeah.
Something I should be doing.
Yeah.
If you are not asking
FOMO.
me to FOMO, if you
Yeah.
are asking me not to do anything, what is the big thing? Then so much things are happening.
Yeah.
You should be suggesting something.
Yeah.
So it becomes sometime a little
Yeah.
funny, but yeah, those are the things which is there
Yeah.
probably.
And you advise HNIs, you advise family offices, as well as you have your corporate clients. Tell us a little bit more about the behavioral differences between them. What is it like for the HNIs more so?
See, they all consist human being. So
Yeah.
the behavior problem remains the same. But yeah, see, obviously a client is an individual, is just a person, single person, at the max a family,
Yeah.
right?
But are they more adaptable to like newer, more exotic products versus a corporate client or?
Well, I would think what happened at the beginning, the objective of a corporate client is much clearer,
Right.
followed by family office and followed by an individual. However, as we go along the journey, most likely the objective do not change much between at least for the corporate client. Objective do change for the family offices, and objective a lot changes in the individual. So that's where really it changes, and the individual is gets more adaptable, more flexible, because can take very easily call for himself, whereas corporate office, corporate treasuries or family office largely as managing, the owner is different, the management is different. So that becomes a little bit of an issue in terms of day to day management, if I had to say, over the journey.
Okay. So when it comes to SIPs, they are not completely risk free. Of course, they are the most safe way to go. What do you think some of the misconceptions are that investors have when it comes to SIPs? Could it be unrealistic expectations? Could it be timing? Could it be constantly monitoring? What is it that they are making when it comes to SIPs?
So specifically about SIP, I think, as I said, the operationally it has become very easy. You have
Right.
online models where you can, and today's generation is absolutely tech savvy. So starting is an operational execution is very, very easy, and that's why they jump into it, right?
Right.
The biggest among everything, what else you have said, for me, if I had to put one particular highlight, is stop SIP. So that's the biggest. See, I think if you continue remain invested and continue keep putting money every time,
Yes.
the average return, even if you have start, one is that you are putting every month. So there's no
Right.
starting point at one particular point. And if you're dipping every time or every month or a predefined frequency, then average return can't be far off than the average return of market. And we all know average return of market. So biggest issue with SIP is stopping that SIP, and then second, and others are follows. Then they are chasing. So you have started SIP in one particular fund scheme. You stop that because you realize, let's say today, a gold has done phenomenal. So you are not now putting any more in equity. You started in gold. Now we all know gold can't continue, or silver for that matter, can't continue to go up like this forever. But they are putting with the expectation of the previous 12-month return.
Right.
Then they will stop that. Then they will move to some other assets. So I think stopping investing in general and SIP specifically is the
That's-
biggest mistake one can make, and
Yeah.
one should not be making.
Absolutely. You spoke about the regulator having done a lot when it comes to investing in SIPs and the awareness. What more would you want to see from the regulators front? Do you have anything on the wish list?
I think, as I said, I think so they have achieved the first target of making sure that people understand the benefit of SIP, and kind of kind of make it attractive for them to invest into SIP. I think as we go, the next stage would be, I think, little more highlight that SIP does not means equal to your FD plus return guaranteed year on year, right? So that I think is something which they're trying, honestly, but more highlighted that if you also in some way or other highlighting that part, that there will be a year, 2 year, 3 year also where you will not have, but eventually you will get your return. See,
Yeah.
the problem, not problem, I would say that's a wrong word to use, but a pattern of a investment class or asset class is very different. A fixed income asset class will keep giving you daily return, but it's obviously the return is lower. Any other asset class which you move from fixed asset class will have a seasonality in its return. The more the return is deferred, the bigger return is awaiting in the next year. Now, if it is deferred 2 year, third year will have. If it is deferred for 5 year, the 6 year will have even bumper return. So that I think is needs to highlight that you have to remain invested and you have to really have a good time horizon. And I
Yeah,
think
that's
that's
critical.
very important to have.
Yeah, a long-term time horizon is
And a long term
absolutely
is
critical.
very loosely used. Believe me,
So,
people say
what's
I
your
have.
definition?
So okay, so people very funnily say I have a very long term view. How much it is? 1 year. I said okay. So if you really look at a asset class like a equity or even the commodity, because now a lot is
Yeah.
spoken, I would look at honestly, and people may get shocked, but you shouldn't be investing if you have a less than 5 years. At least as we speak, you could have a derailment, you
Yeah.
could have an emergency, which is where it's fine. But you should not be judging your performance before 5 years that what happened, because there are enough time frames if we go in the past. Unfortunately, in the recent past, that time frame has been short, but there are enough time frames, point to point time frame,
Fair.
which is where it's taken even 5 years to get you a reasonable return. As I said earlier, that if 5 year has not given return, 6 year will give you even more, and if it's
Okay.
not 6 7, so I think it's difficult to say time frame, but yeah, 5 years should be bare minimum, I would say. One has to look at it really to have, and I say equally important is that other things which you manage, liquidity should be very clear.
Okay.
What are your goals? What is the 3 year goal, 5 years, 7 years, and accordingly bucket your investment.
Okay. Why is it important to define your goals as an investor before investing?
Yes, it's very important because that's the only way you can have each bucket doing fairly well. I'll give you example. If you have a very reasonably 90% probability that you will need certain money after 2 or 3 years, right? It's not at all suggested that you should look at putting in equity that money. You could have a very conservative equity exposure to depending. So whether the liquidity requirement is in 6 months, 2 year, 3 year defines what can you deploy those fund into. And the reason is that if you deploy the right amount into the right instrument with the right time frame, you will get maximize of everything. Now the mistake we people make is because last 1 year, let's say equity has given 15% return, I'm just taking a very hypothetical figure, they believe next 1 year I can get at least 7%.
Yeah.
There's no science to
Doesn't
it.
work like-
You can get -7, right?
Yeah.
But people believe adha to aa hi jayega.
Yeah.
So that's where people kind of make a mistake taking the clue from and the other way around. If the last 1 year has become 5% negative return, people think that this will continue. So
Yeah.
even the 5 year, 7 year money I should not be investing.
Yeah.
So that's the extreme behavior
Absolutely.
which happens, and that's why it's very important to bucket, identify your goal, and
Yeah.
bucketing your investment accordingly.
Yeah. So, for Claritas Wealth, it's been quite a journey for you. Tell us about how many clients you have, what your goal is, what the vision is, and where you see your company headed in the next 5 years, since you said 5 years is important.
We haven't actually thought about 5 year, to be honest. Today, we have about 50 families really where we are. So we are three of us, three co-founders for Claritas.
Okay.
We are right now working very close to about 50 odd families. Each of us is about between 15-20 families, and that's where I firmly believe that you can maximum manage about 35 to 40 families with the breakup that about 10-15 families will require a very regular day-to-day hand-holding or very frequent hand-holding. 15-20 will be okay once in a month or once in a 2 month, and some of them just will meet you once in a quarter. So that's
Yeah.
the kind of a thing, and that's why you can manage about 40 odd families. So we are currently about totally between three of us 50, so that given that number we can go up to 120 families in terms of asset and everything right now. So we are basically looking families to manage, really not so much of the thing. So we are looking at the bucket of more of a family individual family or family offices.
Yeah.
Our size would be about $1 million, so about 8 to 10 crore to between about 30 to 50 crore is what really we are looking at the client size, approximately in that band. Having said that, currently we manage families which has a 150 to even 400 crore of assets really, and we would love to be have a recall value for a client about us is that, you know, a reliable person or reliable entity.
Yeah.
I think at the end of the day, I don't think I want a client to speak to his friend saying that they give me the best return. I want to be referred as they are always available when I need it,
Okay.
and they understand me and they warn me a lot. They go against,
Absolutely.
they correct me many times. We have a many time argument, but they correct me.
Hmm.
They don't give up easily, and they don't just end up saying ye le lo because I've said them.
I want
They in
to.
fact have a lot of time arguments. So probably around that kind of a image in client's mind for us, that is
Okay.
what we aspire to have.
And I have no doubt that you will go ahead and achieve that and lots more. And I think that is very important, especially from a client perspective. It's very interesting that you brought up the analogy between health and wealth, and as well spoken about the mistakes, how you see SIP flows growing, as well as the market regulators' view. Thank you so much, Shailendra, for talking to us today.
Thank you so much again. It's a pleasure, and really thank you so much for giving the opportunity.
And I think if viewers take away just one thing from this, it should be that investing is not about choosing a fund, but it's important to actually build a system. And that is a system that can handle optimism, fear, noise, and still keep you moving toward your long term goals. So that's it from me today. Thank you so much for watching.